Hey everyone, this is Mondragon with PlutusX. We're teaching you how to not only identify structure, but also utilize it when trying to build a profitable trading strategy. So we'll go through a high-level overview of what structure is when we're talking about charts. What structure is simple. We got the definitions right here. Structure is the most widely used tool in trading, yet everyone has their own method of measurement. So if you remember back in our earlier video in the series, we had talked about how a majority of the trading is actually retail traders and trader psychology. So to increase your odds at building a profitable trading strategy that's accurate, it's advantageous for you to definitely try to use tools that majority of the other retail traders are using. Remember, if it's trader psychology and if majority of the individuals are retail traders, then if they believe it's going one direction, the likelihood of it going in that direction increases tremendously. So we got support and resistance. When crypto or other instruments market moves up and then pulls back, the highest point reached before the pullback is now resistance. As the market continues up again and the lowest point is reached before it started to back up, that is now support. Trend lines in their most basic form, an uptrend is a line drawn along the bottom of easily identifiable support areas, also known as valleys, and a downtrend is a trend line drawn along the top of easily identifiable resistant areas, also known as peaks. So now that we have the basic overview and definitions of what structure, resistance, support, and trend lines are, we can move on to the next part. So here is exactly what the definitions are talking about. So we got price moving up and then it pulls back down, creating a resistance line. And then when it pulls down, it hits an area of support and goes back up. So it doesn't go past that area. And that line is now considered support. And markets continually do this. So we can see that it's oscillating in an upward trend. Because if we were to draw a line from the first support to the second support, we can see that the low is higher than the previous low. Similarly, we can see that the high is higher than the previous high. So we got an uptrend coming, and that's an uptrend channel, and we'll go more about those actual patterns later on. So in structure, there's something called false breakouts, and a false breakout is essentially where you create a support line or resistant line or zones and trend lines, and price is breaking through those support areas or resistant areas, but sometimes fundamentals can play a role in this, and the breakout is only temporary, whereas after the news is released, price action will go back and start abiding by the technical analysis again. So how do we prevent false breakouts? To help you filter out these false breakouts, you should think of support and resistance more as zones rather than a concrete number. A great tip for you to find these zones is to not use the candlestick charts, but instead use a line chart. A line chart in the closed position will show you the real true value or true price of that particular chart. Whereas if you use the candle, you can get extreme highs and extreme lows using the wicks, and that would be less accurate. So here's an example of using line charts. So here we can see and easily identify resistance zones and support zones based on the closing price of these line charts. So here's a couple of tips for success when you're looking at structure. When price passes through resistance, that resistance could potentially become support. So if you look left, the chart always leaves clues, and what was previously support can turn into resistance, and what was previously resistance could turn into support. The more often a price tests the level of resistance or support without breaking it, the stronger of an area the resistance or support becomes. So if we go back here, we can see it on the left hand side where the support zone is at. We can see that price touches it not only once, but not only twice, but 3 times, and somewhat 4 times as well, and it respects it. And we see that it continues moving up on the 3rd time. And like I said on pro tip number 1, support can become resistance and vice versa. So if we go back here, the green support zone on the left, we can see that it actually becomes resistance on the right side right after the second support zone. But it wasn't that strong, so obviously it broke through and continued back up. So when support or resistance levels breaks, the strength of the follow-through move depends on how strongly the broken support or resistance has been holding. So if we go back here, like I said, once again to the left-hand support zone, we can see that, like I said, it was support for 4 touches on the zone, which means it had some significant resistance. And when it broke through, it just dropped. And that's what it's talking about right here. So the breakthrough and the follow-through of the move depends on how strong this support or resistance was, and how significant it was, and how strongly it broke through that support or resistance line. So we can see here that it just had a lot of momentum when it came through that support zone, and it broke through, turning it into a resistance zone actually. So yeah, that's pretty much it. It's really basic. You want to use line charts to help better identify these support resistance zones, and then we'll go into trend lines a little bit later as well. But for now, we can kind of look at some charts that we had put together, and this is going to be inside our MAM account. So we got Swiss franc and the Japanese yen, and we can have some clearly identified support zones. So that's going to be identified as the blue chart, or the blue squares, rectangles. So we can see that price is kind of respecting these areas, and when we create a zone, that means it's typically going to be a good area for purchasing or selling. Let's see if we could find some other one. These ones are going to be better examples for trend lines, which we'll cover soon. Here we can also see at the euro pound pair, we can see at the 0.89 line, we got a great line of resistance or support right here. The chart touches it almost once, twice, 2, 3 times, and then when it breaks it, we can see what happens next. It comes from a support zone and turns into a resistance zone, turning in just resistance once and resistance twice. Since it held up as a support zone 3 times, almost 4, we can tell that by the breakthrough of the candle that we're going to have some significant momentum following the breakthrough. We get that confirmation with this reversal candle right here, and once again when it touches it and fails to break through once again, we can tell immediately that it's going to have a reversal split, and it's not going to come back up in that direction. So once again, this was a significant support zone. It was tested 3 times, almost 4. Momentum broke through, it was retested, came back down, turned into resistance, and then it followed through with the bearish momentum. So that's something that you could expect, and that's happening all the time. And we can see here that this was actually support, or resistance, excuse me. So it touched it 1, 2, and 3, 4 as well, if you could count that. So that's really the basics of finding support and resistance. You can just take a high-level overview of these charts, and you can easily identify areas that are support and resistance. And what you're going to use is the horizontal lines to identify and help mark these support and resistant lines. It's best for you to be in a 4-hour to a daily time range. There's something called a daily pivot point, and that's basically signifying the higher the time frame, the more significant the resistance and support line is. So if you're on a 4-hour, it's going to be extremely more significant than if you were on a 1-minute chart. The reason why is because there's more price within that time frame. You come back here into the trend lines, and trend lines, we already talked about that as a definition. The most basic form, an uptrend and a downtrend, and we're going to be drawing them adjacent to the valleys and peaks of the chart. So we got an uptrend, and that's using the support zones or the valleys, and we're using that as an uptrend. And then for the downtrend, we're going to be utilizing mainly the resistant lines or the peaks of the charts. And the way to identify trends is to have higher lows or higher highs, and to identify downtrends, it's going to be the exact opposite. You're going to have lower lows or lower highs. And then we also have the last one of a trend, which is called sideways. In the market, 70% of the time is going to be in a sideways trend, which is called ranging. So here we just have a basic chart, and we can easily identify some of the trends. We got sideways trend in the middle with the black lines. We have a downward trend with identified as the red line, and the upward trend identified as the blue lines. So pro tips for success when you're utilizing trend lines in your chart analysis: it takes at least 2 tops or 2 bottoms to draw a valid trend line, but it takes 3 to confirm a trend line. And this is something that I want to discuss and put a lot of emphasis on. You do not want to force a trend line to be in existence, and the angle of the trend line is important. So if the angle of the trend line starts approaching 90 degrees, the likelihood of that trend line being valid diminishes exponentially. So you want it to be closer to 0 or 180 or horizontal as possible. The closer it is to that, the more valid that trend line is going to be. If it's closer to 90, it's just going to be a straight line, and it's going to be a vertical line, and price is going to be undoubtedly moving past that, as a result not being a significant trend line. And that's pro tip number 2. The steeper the trend line you draw, the less reliable it's going to be, and the more likely it will break. Price is least likely to break through a horizontal line than it is to a vertical line. It's undoubtedly going to break through a vertical line. So just like support and resistance levels and zones, the more the trend lines are tested, the more significant and stronger those trend lines become. So remember, it takes 3 to confirm it, but if there's 3 or more touches to that particular trend line, then we can say with certainty that that trend line holds more significance than the lesser. And going on basically the same thing as tip number 2 is, do not ever draw trend lines by forcing them to fit the market. If they do not fit right, then the trend is not valid. So like I said, we're going to explore these charts real quick. So these ones are going to be called harmonic patterns, just so you know, and we're going to go through that eventually. Harmonic patterns are utilizing price action and Fibonacci's, and they have a high level of accuracy as well. So we'll go through those eventually, but right now we're just going to stick to trend lines. So we can see here 1, 2, 3, 4. So 2 to draw the trend line, 3 to confirm it. Anything past 3 means it's more significant. So we can see we have an ascending trend line right here. We're using the valleys to determine the uptrend. We got 1, 2, 3, and 4 possibly. Then we also use trend lines in addition to our support and resistance zones to identify gray areas of buying. So we can see that we have a resistance zone right here. We have 1, 2, 3, and then kind of turned into support right here, 4, and then we could kind of count these ones, 5, 6, and then we have the other part of the zone, which is this resistant line above here. So 1, 2, 3. So that means in this particular zone between these two lines, we have a great opportunity for either buying or selling. But based on our uptrend, we can see that it's a great opportunity for buying. However, if it breaks through this downtrend and we'll wait for a confirmation candle, then it's a great opportunity for us to sell. Here we have a descending trend line, 1, 2, 3. Price action abided by this resistant downtrend 3 times. We got a lower high, 1, and another lower high, 2. We see that we have 2 to create the trend line, 3 to confirm it. Once again, we're using price action to determine resistance and support zones. We can see that we have a support zone right here, and the zone once again signifying a great opportunity for us to buy in. Go back to this initial chart. We have 1, 2 to draw the line, 3 to confirm it, and then we have a little bit of price action abiding it right here. When we break the trend line, depending on the strength of the breakout, we can determine whether or not it would be sufficient enough for us to go against that trend line and either purchase or sell it. We can see here on the descending trend line, price broke through. We had an undetermined candle that came through. We waited for it to test back. We can see that price action respected the new descending trend line as resistance and turned it into support. So that means we can now safely assume that it's going to break the trend line and continue going up as a reversal. And that's exactly what happened here. When you're creating trend lines, you could also create something called a channel. And that's exactly what this is right here. A channel needs to be parallel with each other, and a channel basically represents price action moving in that range. Channels are typically reserved for ranging price action. So for example, right here we could have a range 1, 2, and price is going sideways. However, the bigger picture on a daily chart, we can see that price is actually ascending. And in this range, when price broke out, we had a breakout right here with an undetermined reversal candle potentially coming back down. However, price did not respect this resistance zone, and it continued going up. We waited for a drawback to retest it, and it turned this resistance zone into support. And as you can see, after this candle closed, it just shot right back up, respecting this new resistant line as support. And that's really it. So the best way to actually get better at this is just looking at the charts and finding resistant lines yourself and support and trend lines. So that's pretty much the basics. The only way you're going to get good at it is obviously practicing. So go onto TradingView and pick a chart that you want, and then go to the actual charts itself. So here we're on a 4-hour time frame, and we could actually easily identify an uptrend right here. We've got an uptrend right there, and then we could actually create a channel with this uptrend. Check this out. Boom. And once again, these are not concrete lines or numbers. We're going to be creating a zone. So we can see here that there's a little bit of leeway between this particular zone here and this particular zone here. But we can see that since price action abided this particular trend line 3 times, confirming it, that when it broke through, depending on what's happening right here, we can expect extreme momentum coming on the down end. And that's exactly what happened. You can see we got a black crows, which is 3 bearish candles. It's a good signal for a bearish momentum. Some consolidation with a little flag forming. And the likelihood of it continuing to drop down increases exponentially, because now we have new resistance right here, and it respected it. So the likelihood of it coming back here and touching it, we can see that price is respecting it multiple times along this line right here. So the likelihood of it coming here, touching it again, and respecting it is high. And remember, we're just using this in addition to other technical analysis tools to help increase our odds of being accurate when placing a trade or executing an order. So we're only using this information in addition to other tools such as EMAs, which we're going to talk about, Fibonacci's, which we're going to talk about, other price action, which we're going to talk about, and other patterns. So take that in consideration. It's really simple. The only way you're going to get good at it, though, is just by going onto the charts and actually finding these trend lines and support and resistance zones. That being said, come back to the next video. We're going to actually be talking about Fibonacci's. And Fibonacci's are the foundation for things like I mentioned called harmonic patterns, such as this. And most of these harmonic patterns have an accuracy rate of anywhere from 76% to 82%. And that's the average. It's really great, especially if you're trading. So it's something that you want to definitely keep in your arsenal. But I would recommend you only get to these harmonic patterns when you have mastered price action, both support and resistance zones and trend lines. Thanks again. Talk to you guys soon.